Peter Rose, Longwood Currency Trading. 2 simple ways to Forex trading profit. That's what I'd like to chat about today. 2 simple ways to profits, almost guaranteed. But first, a fellow trader and friend of mine, his grandfather is failing. And I'd like to just bring to your attention that sometimes we need to think about folks that maybe we don't know. And let's take our next trade for Harry and dedicate that trade to him. Just to think about him, to send some good thoughts out for him. And even if you're listening to this video 5 years from now and maybe Harry's not even with us anymore, don't just trade for yourself. Have something larger that you'd like to go for. So Gary, for your grandfather, my next trade will be for Harry. All right, 2 simple ways to Forex trading profits. First, exit a losing trade immediately. How many times have I said that? And second, you have to learn how to correctly manage the average position value of your trade when you're staging lots. Those are the 2 simple ways. If you could do those 2 simple things and very little of anything else, you'd be okay. In particular is getting out of a losing trade as soon as you can. Now, that's really a scalper's methodology, right? Because you're only scalping for 2, 3, 4 pips at a time, so you're in, you're out. You might scalp if you have a really low cost of doing business. If your vig is low, you know, most of us will be in that 1 to 1.2 pip spread range, and so if you're scalping, you can't scalp for 2 pips because you've already lost that in the bag. Scalping is very difficult if your broker is charging you spread. So, you know, you go for 4 or 5 pips as your maximum target, and you get out at 3 or 4, and you make the difference. But you do that a dozen times or 2 dozen times a day. And those 1 or 2 pips that you average making, I mean, your win-to-loss ratio has got to be really high in order to be a scalper, a successful scalper. You can't be a 60-40 trader and scalp. You know, you're going to have to be 80-85% win to loss in order to cancel out the vig, right? You get 2 pips 20 times a day, you've made 40 pips. That's a huge number of pips. But you've got to get out right away. Why do you get out right away when you're scalping? Because you can't afford to add the spread cost and the loss cost into your trading because you're not trying to trade for very many pips. Let's take out the very many, making the very many pips, and just say any number of pips profit. Any number of pips profit is good, but you'll never get that profit if the price swings around and goes against you. If you don't get out of a losing trade right away, then those negative balances, the PL, mounts up. And it's very hard not to trade for dollars, right? So you put a couple of trades on and you lose 20 pips each time. So you're 40 pips down on whatever size bank you're trading. Maybe you're trading a couple of minis. So you're $40 down. That's a lot. How do you, or it'd be $80, right? You're trading 2 minis. How do you justify getting out of that trade early? All the reasonable knowledge, our intuition says give it a little bit of room to breathe. You know, price, it goes up and it comes down, and it goes up and it comes down a little bit, and it goes up, and over the long run it goes up, right? And so you've got to account for those dips. Maybe look at your chart. Go on the 5-minute chart and look at your time to the swing point, and in other words, in pip distance, and the pip distance of the retracement. It'll vary, but if you're on the majors, you might have I don't know, 15 pips to a swing, and then 10 or 15 pips on a retracement, sometimes 20. And you're trying to catch things, and you've got the swing. You don't know where you're at in that cycle unless you're really good at judging those periodicities. And so, how do you know that the retracement that is going to take place is going to be 10 pips or 100? You don't. And so that's the rationale for taking a 20 pip stop. So because you don't know, but the average is about 15, then in the periodicity things, you might get 1 in 5 trades or 1 in 8 trades that goes below the 20 pip stop that you've got. And that makes a lot of sense. But you've got to be a really good trader in order to even make up for that 20 pip loss. Because don't we all hang on to losers and get out of winners too early? Hang on to losers too long and get out of winners too soon? It's just in our DNA. When I teach trading, I don't teach trying to avoid and change your DNA to change your personality. You have to go with your personality. Although what happens is you need to change that so that you don't mind taking that loss. And there's a way of thinking about that I teach that allows you to take the loss and be happy. But even I still fail to that, and I don't take that short loss. And I regret it every time I do it. So that's number one. Number two is correctly managing your average position value as you're staging lots. If you have done any staging before, and I don't suggest that you do that, I don't know, in some of the videos I say you got to have a $30,000 account or bigger in order to stage, and who's got $30,000? So I'm just talking primarily to the 21 to 34-year-old age group who is trying to get to the skill level where they could successfully trade a 6-figure account or a high 5-figure account. And so a lot of the advice, all of the advice that I give is for those folks. I'm trying to teach you how to think and how to manage your trading process so that when you get to that larger account size, you'll be successful. If you're in a situation where $5,000 is all you can come up with so that you can trade 5 minis, okay. The principles that I'm teaching up higher are still valid for you. In other words, I say don't start compounding and don't start staging until you have a $30,000 or so account, because you've built up this all-in, all-out, really good trading principles and have established a really good win-to-loss ratio, which allows you then to experiment with compounding and staging and averaging and negative averaging and all the rest of the stuff. But you can still do that with 3 to 5 minis. It's just that if you're trading 3 to 5 minis, the assumption is that you haven't got the experience yet to put more money at stake. It's an expensive game. You wouldn't expect to drive your little Pinto or Corolla in the Indy 500. I'm sorry, you love to drive your car and you love to drive it fast, but you're not going to be able to participate in the Indy 500. You're not. And so, and win a trophy and win any money. You're not going to replace your job income by trading 5 minis. You're not going to replace your job income trading 2 full lots. You're not. You need to trade bigger numbers in order to make bigger numbers, because remember, you're losing and sometimes you're gaining. And so to try to do some of this stuff with 5 mini lots is trading for the money. But how much money are you going to make with 5 mini lots? I mean, even if you doubled your account every year, at some point, by taking all those risks, you're going to lose it all. Trading currencies, because of the volatility, which is magnified by the great margin that we have, really requires a tremendous amount of skill before you risk a lot of money. Just because you have a lot of money doesn't mean you're going to be successful trading currencies. There are rules that you need to learn and follow, and processes that you need to adapt in your trading. Getting out of a losing trade is one. But if you're in a situation where you are staging, whether you're staging with 5 fulls or 5 minis, doesn't make any difference. If you're going to stage, each time you stage a lot in, for example, if you're staging up, each time you stage in, it raises the average price of the position, right? The average value of the position. So if you stage in heavier as you go up, the average price goes higher. In other words, it becomes closer to your current price. And so if you have a retracement of price at that point, and that retracement is 5 pips or 10 pips, you're underwater. You're below your average position. You've staged in, let's say you're staging 5 fulls in and you've got your full load on, but you put 3 of those lots on at the top. So now your average position is very close to wherever your current price is, and it goes against you. How long are you going to hold that? If you can't get out of a losing trade early in just the entry stage, what makes you think you're going to be able to exit that trade when you've got 5 full lots on and you're gunning for the big win, and now all of a sudden it goes 8 pips against you and you're 2 pips underwater? Well, it's only 2 pips, it'll come back. And then it's all of a sudden it's 10 pips underwater. You're 10 pips underwater on 5 full lots. You're you're $500 under. So you see, the two simple techniques that I'm talking to you about are interrelated. If you can't take that short stop at entry, you're not going to be able to get out when you've staged in lots. And look, even if your position is low than your current price, is below that, so let's say it's 15 pips below that, and you can do that. You got to be careful and balance that, and I teach that. There's a whole section of that in one of the course books in the Advanced Solutions book, the 4th course book. Talk a lot about that. But even if you have that 15 pips, if your average retracement is 8 or 10 pips, and the thing is going down, listen, maybe you've gone on and that thing has gone up, so your position value is a couple of $1,000 in your staging, and now you're losing 8 of those pips before you get to that. Maybe it's 12 pips is your average position, and you've lost 8 pips of your gain. So now you're 4 pips to the drop dead zone, but you've lost 8 pips on maybe a 10 lot. Well, that's $800, and Yeah, you lost 8 pips on a 10. Yeah, you're 800 bucks down. So how's that going to make you feel? And are you going to get paid? Yes, you're going to get paid 4 pips on 10. You're going to make $400, but you just lost 8 for you. You had a total of $1,200. Are you going to consider yourself a successful trader? You've got to manage your expectations on the trade, and you've got to cut your losses as fast as you can. If you can learn to do that, exit a losing trade immediately, that will transfer over into the whole rest of your trading methodology. And I'll bet if you just exit a losing trade right away, I'll bet you go to profit right away. If you're a losing trader, I'll bet you go to profit right away. Try it. Who knows? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.